Welcome back. It's great to see you again. Last time, we tackled something that usually makes people want to run for the hills: budgeting. We broke down how to build a no-stress budget from the ground up in under an hour. If you did that homework, congratulations, you are already ahead of the pack. But budgeting is only the first step. It gets your financial house in order. Once your house is in order, you might realize you have a little bit of money left over at the end of the month. What do you do with it? You might be thinking, I'll just leave it in my checking account. Or maybe a savings account. It's safe there, right? Well, not exactly. You see, holding on to cash is kind of like trying to carry water in a leaky bucket. That leak is called inflation. Every year, the cost of groceries, rent, gas, and practically everything else goes up. Because of inflation, the cash sitting under your mattress or in a basic checking account is actively losing its buying power. So, we have to invest. We have to put our money to work so it grows faster than inflation. But when I say the word investing, I know exactly what pops into your head. You're picturing a guy in a tailored suit, surrounded by 6 glowing computer monitors, shouting into a phone. You're picturing someone obsessively checking stock charts at 3 a.m, stressing out over every little dip and spike in the market. You are picturing active investing. Active investing is when you try to pick winning stocks, time the market, and jump in and out of trades to make a quick buck. Sounds exciting. It feels like a movie. But here's the brutal truth. It is incredibly risky, highly stressful, and frankly, it is a terrible idea for most of us. When you actively trade, you are competing against massive financial institutions with supercomputers and algorithms. You are basically walking into a casino. And just like a casino, the house almost always wins. Even the so-called professionals, the highly paid fund managers on Wall Street, fail to beat the market average over a long period. And on top of that, active management comes with a ton of hidden fees. Every time you buy or sell, someone is taking a cut. Over time, those fees will absolutely eat your wealth alive. So if cash is a leaky bucket and active investing is a stressful casino, what is the alternative? How do we build wealth without making it a full-time second job? The answer is passive investing. It is the lazy, boring, and highly effective way to grow your money. And honestly, boring is exactly what we want when it comes to our finances. Passive investing is all about capturing the growth of the overall economy over time, rather than trying to guess which specific company will be the next big thing. The legendary investor John Bogle, who pioneered the index fund, had a brilliant way of describing this. He said, "Don't look for the needle in the haystack. Just buy the haystack." Instead of trying to find the one perfect stock, the needle, you just buy a tiny piece of every single successful company, the haystack. How do you buy a haystack? Through something called an index fund, or an ETF, which stands for Exchange Traded Fund. Let's use the S&P 500 as an example. The S&P 500 is simply a list of 500 of the largest, most profitable companies in the United States. Think Apple, Microsoft, Amazon, and 497 others. If you buy an S&P 500 index fund, you are buying a single basket that holds tiny pieces of all 500 companies. If one company goes bankrupt, it doesn't matter, because the other 499 are there to prop you up. You are betting on the overall success of the economy. Whether you live in the US, Canada, or the UK, there are broad market funds that allow you to own a slice of your national economy, or even the entire global economy. And history tells us that over the long term, despite wars, recessions, and crises, the global economy goes up. Human beings are innovative. We invent new things. We become more efficient, and businesses grow. When you buy an index fund, you get to ride that wave of human progress. Now let's talk about the magic ingredient that makes passive investing so incredibly powerful. It's a concept that Albert Einstein supposedly called the 8th wonder of the world: compound interest. Compound interest is the snowball effect of your money. Imagine you plant a small seed and it grows into an apple tree. Eventually, that tree produces apples. If you eat the apples, great. You had a snack. But if you take the seeds from those new apples and plant them, you don't just have one tree anymore. You are growing an orchard. When you invest in an index fund, the companies inside that fund will regularly pay out a portion of their profits to you. These are called dividends. If you take those dividends and automatically use them to buy more shares of the index fund, your money starts making money. And then the money your money made starts making money. Over 10, 20, or 30 years, this snowball effect becomes an unstoppable avalanche of wealth. The key to compounding is time. It doesn't matter if you can only afford to invest $50 a month. What matters is that you start now. The person who invests a little bit early in their life will almost always beat the person who tries to invest massive amounts much later. Time is your greatest asset. So, how do we practically do this without stressing out? We use a strategy called dollar cost averaging. I know it sounds like finance jargon, but it's remarkably simple. Dollar cost averaging just means you invest a set amount of money on a regular schedule, no matter what the stock market is doing. Whether the market is at an all-time high or crashing to an all-time low, you buy. When the market is up, your fixed dollar amount buys fewer shares. But when the market is down, stocks are essentially on sale. Your fixed dollar amount buys more shares. You don't have to think about it. You don't have to check the news. You just keep buying the haystack. And the best way to maintain this consistency is through automation. Every time you get paid, before you even have a chance to look at the money in your checking account, a portion of it should automatically transfer into your investment account and buy your chosen index fund. You set it up once, and a computer does the heavy lifting for the rest of your life. It is the ultimate set it and forget it system. It removes human emotion from the equation, and human emotion is usually what ruins a good investment strategy. Now, I want to pause here and talk about a trap that a lot of people fall into when they discover the math behind passive investing. They realize that every dollar they save now could be worth $10 in retirement. Because of this, they stop spending money entirely. They eat nothing but rice and beans. They stop going out with friends. They refuse to travel. They practice extreme frugality in the pursuit of wealth. I strongly believe that extreme frugality is a mistake. Yes, we want to invest. But what is the point of having a giant pile of money when you are 80 years old if you're miserable and deprived in your 20s, 30s, and 40s? Money is a tool. It is meant to serve your life, not the other way around. The beauty of automating your passive investments is that once your monthly contribution is taken care of, you are free. You hit your goal for the month. The rest of your money is yours to spend completely guilt-free on the things that bring you true joy. If you love traveling, buy the plane ticket. If you love good coffee, buy the latte. Don't be cheap when it comes to your passions. Just be ruthless about cutting costs on the things you don't care about. Now, I know some of you are still hesitant. You are worried about a market crash. You remember 2008 or the crash of 2020. You turn on the TV and the news anchors are screaming that the sky is falling. Here is what you need to know about financial news. Their goal is not to make you rich. Their goal is to make you click. Panic gets views. Fear sells advertisements. When the market drops, and it will drop, it feels terrifying. But I want you to think of the stock market like a roller coaster. When you get on a roller coaster, you expect to go up and you expect to go down. The ride is going to be bumpy. But the only people who get hurt on a roller coaster are the ones who try to jump off in the middle of the ride. When the market crashes, do not panic sell. When you sell during a crash, you lock in your losses. You turn a temporary dip into a permanent disaster. If you have a strong, diversified index fund, your portfolio will weather the storm. Over a 20-year period, those terrifying crashes look like tiny little blips on a massive upward mountain of growth. You just have to zoom out. Put on your noise-canceling headphones, ignore the news, and go walk your dog. To keep it incredibly simple, many people use what's called a target retirement fund. You simply pick the year you want to retire, say 2050, and buy that single fund. The fund manager automatically balances your money between riskier stocks for growth and safer bonds for stability. As you get closer to retirement, the fund automatically becomes more conservative. It is a one-stop shop for total financial peace of mind. So let's recap the lazy way to wealth. Step 1. Stop holding all your money in cash where inflation will eat it. Step 2. Ignore the stressful casino of active trading. Step 3. Buy a broad index fund or target date fund. Step 4. Automate your monthly contributions. Step 5. Ignore the news and never panic sell. And finally, Step 6. Go live your life and spend on your passions guilt-free. Once you have this automated machine running in the background, your wealth will grow quietly and consistently. But before we can truly relax, we have to make sure we are protected from the unexpected. And we need to deal with the one thing that will actively destroy our wealth faster than anything else: bad debt. Next time, we are going to dive into how to crush any remaining bad debt you have while building an unbreakable safety net with an emergency fund. Thank you so much for watching. If you found this helpful, hit that like button, and I will see you in the next episode.